And good evening, ladies and gentlemen. How are all of you on this fine Monday evening as we are jumping into level 2, class number 7. So that's actually, if you look at all the classes, we're like 15 classes into Foundations of Stocks and Options tonight. And tonight we're getting into Indicators Part 1. And I think that you guys are going to really enjoy what we're going to be talking about tonight. So welcome. Welcome to a new week. New week of trading, new week of foundations, and let's not waste any time. We've got a lot of information to get through tonight. Tonight we're going to take an introduction into indicators. We're going to do a basics of oscillators overview, and then we're going to talk about the 3 oscillators as we move forward into the evening. So let's go ahead and do it. Let's do that introduction into indicators. And to start our discussion, we will ask that age-old question, what are indicators? And kind of on a broad scale, indicators really refer to any type of a data that can be analyzed and applied to the market to help us predict future price movement in a security. So if that sounds like a complicated definition, it's really not. It's actually one of the simpler definitions out there. Basically, indicators are just things that we look at to give us an idea of where things might be moving. Now, typically speaking, a lot of times when we think of indicators, we actually think of fundamental indicators. And so you might look at things like job reports or Federal Reserve announcements and things of that nature, which tend to affect the fundamental aspect of it. People will say these are economic indicators, what are the housing starts? And there's a whole bunch of economic indicators that people will refer to. Sometimes even people will look at things like weather indications and what might be happening in weather and how could that affect the futures market in terms of what it might do to a crop of corn, for example. And so there's all sorts of things that we might look at in terms of indicating what might occur in the future, but those are not the type of indicators that we are discussing tonight. As you guys know, I'm a technical trader, and in the world of technical analysis, there are a whole bunch of indicators that we call technical indicators. So that's what we're really getting into tonight. Technical indicators are metrics and data, as we have defined it here, metrics and data whose information is derived solely from the price and or volume related to the stock. In other words, we are taking the price chart and we're deriving information from the price chart and creating these indicators. Now, I've listed several here: stochastics, RSI, MACD, Bollinger Bands. These are all indicators that we will be learning about tonight. We're going to learn about the top 3. And in the next class, we'll learn about a few additional indicators that we're going to be studying and working with. Whenever we think about these technical indicators, these specific ones, they can be derived from any combination of the following: the open high, the low close, or the volume. A lot of indicators will take all 5 of these and synthesize them together. Some indicators just take 1 or 2 of them and synthesize them together into various forms. Then we'll take them over a certain number of days, and it usually there's some averaging and some sort of complicated math involved in pretty much the case of all of the indicators. So, all the indicators we're looking at are pretty much taking these 5 basic pieces of data, and somehow through the formulas that they work with, depending on the indicator, they're coming out with the signals that they get. Whenever we talk about technical indicators, they are a reflection in some way, shape, or form of the underlying price of the security. So, you're trading Apple. Whenever we talk about the indicators as they look to Apple, they're a reflection of the Apple price. And whenever we think about how we can use them, literally through various formulas and calculations and whatnot, they can be manipulated into what seems like an endless variation of data output. In fact, we've got hundreds of indicators available in the market. There's just tons of them, way more than it's ever practical to look at. Some of the formulas are very complicated. Some of them are very simple. We've literally got, it seems like, indicators for everything. And interestingly enough, people are always creating new indicators. Some of them have value. Some of them have 0 value. Most of them have very little value most of the time. But anyway, that's kind of a good little overview there. In a nutshell, here's the way I'd like to wrap it up for you. Technical indicators are tools that we use to interpret the price and the volume information as it's related to a stock. That's kind of my J-Dub's definition of what technical indicators are. It's just tools that we use to interpret the price and volume information related to a stock. Now, as we think about what technical indicators are, one of the important things is to say what they are not. And I'd like to start this and say they are not the most important piece of information. As we look at our analysis process, your line drawing, your moving averages, which actually, truthfully, moving averages are a type of technical indicator. But you look at your line drawing, your averages, your candlestick patterns, your chart patterns. These pieces of information are really a lot more important than your indicators. And so, it's really important that you do not forget those. However, the temptation is, because indicators are oftentimes extremely persuasive in what they offer, the temptation is that people would look at the indicator and say, well, that's what the indicator tells me, that's what I'm going to do. And that's a very incomplete view of working with indicators, and it's a very incomplete view of trading the market in analysis. Technical indicators are not a complete analysis in and of themselves. They should not be used to trade from directly, and what they need to be done is it needs to be used as part of a bigger system of trading. So what are indicators? What are we going to use them for? Well, they're a great way to measure the underlying price action. They're a great tool to help us confirm our analysis. And this is really what I want to drive home. Indicators are used to help us confirm our analysis, and they're also a great tool for alerting us to things that we may have not seen before. And really, that's all indicators are. They're just a tool to help confirm our analysis or alert us to something that we did not see before. Now, there are a few technical indicators that are outside of this definition. For example, put-call ratios. That is going to be the ratio of how many puts are in the market versus the number of calls that are being written at the moment. That's an options measurement. That's really more of a fundamental aspect, but it's considered a technical indicator. Public sentiment indicators. For example, there's a lot of, when I say there's a lot, there's companies like tradefutures.com that will poll, what do you call them? Like referral services. What am I trying to say here? The poll companies that think here. Advisory services. That's what I'm trying to say. They'll poll advisory services, and they'll get a pulse on what X number of advisory services across the industry are saying. And when the public sentiment indicators are extremely bullish, they'll be publishing that, or when they're extremely bearish, they'll publish it. And sometimes those type of sentiment indicators are beneficial for contrarian investing. They are not the type of technical indicators we're dealing with tonight, though. Then you've also got the intermarket analysis that can also be considered a technical indicator. We are not getting into those type of indications. So the word itself, indicators, can be a bit of a broad term. It can be applied to anything that we use to help forecast future price movement. Excuse me. Anything we would use, again, you know what, let me just drink some water, make this a lot easier. Hold on a second. All right, let's see if that helps me out here. What was I saying there? Indicators are anything that we can use to help forecast future price movement in the stock. So there's kind of a little overview there of the indicators. Let's deal more specifically tonight with what we're going to be talking about, and that is your oscillators. And oscillators are a very specific qualification of indicators that are the type of indicators we're going to put directly on the chart. They are a technical indicator, and they're going to be a measurement of the momentum that's going on in the stock. They are also called momentum indicators. So if you hear the phrase momentum indicators, most likely they are referring to oscillators in some way, shape, or form. And what an oscillator is, in its most simple definition, is it's a way to measure the momentum behind a move. In other words, if we're in a bullish swing, how fast is that swing happening? How much momentum is there behind that swing? If we're in a bearish move, how much momentum is there behind that move? What they're designed to do is they're designed to track the peaks and the valleys of a stock's price movement. So they're constantly going to be tracking as the stock makes higher highs, the oscillator is going to be tracking with it. So let me just draw something on here real fast here. You know that price actions go something like this. Well, the oscillator literally is tracking those peaks and the valleys of the stock, and it's charting it, or it's plotting it across the oscillator. Most of the time, they tend to follow along pretty closely to the chart itself, the price action of the stock. More often than not, they're going to look very, very similar to the stock. However, sometimes they take a different course, and those little different courses, that's exactly what we're looking for. Those are the kind of signals we're watching for. Most of the oscillators are going to be built around the open, high, low, and close prices of your stock. Sometimes there'll be a combination of those. Most of the time, certainly the ones we'll be looking at tonight, are actually an average of one of the prices, maybe multiple prices. For example, stochastics that we're going to be looking at is going to take the high and the low. It's going to average it over a few different days and add some more stuff to it. So these formulas get a little bit complicated sometimes, but if you can just understand that the core of it is it's taking that core price data, it's putting it into the oscillator, it's spitting out the data, and then that gives us something that we can read, something that we can interpret in terms of the momentum. Now, the word oscillator comes from this idea of like a sine wave. Some of you are familiar with audio sine waves. It's not a foreign concept for sure. Basically, it's just the idea that it's oscillating back and forth. And so, it'll cycle down, it'll cycle up, cycle down, cycle up. And you're going to notice on these oscillators, one thing's very different on the oscillators than the chart. The oscillators tend to really progress sideways, whereas the chart, the stock itself, will tend to move in trends. And that's actually the very reason we use the oscillators. The very reason we use the oscillators to try to pull into more of a sideways movement, something that we can measure the cycles of the trend. Because realize trends move in cycles, just like everything else in the world. Trends move in cycles. And so, if a trend is cycling higher and higher through here, we may have a hard time measuring that. But if the oscillator has told us, hey, it's time for this trend to cycle back down, well, sure enough, pretty soon, somewhere right in there, either right spot on or within a day or two, that trend usually will cycle back in the opposite direction along with the oscillator. And so that's really what the oscillator is doing. One of the easiest ways to remember and to think about an oscillator is the idea of gravity. This is a really good analogy here. Just imagine you have a ball, and let's say that you throw the ball up in the air. Well, the ball comes up in the air, and there comes a point where it's still ascending, but the forces of gravity are taking over, and then eventually it hits a tipping point. Gravity sends it tumbling back down. Okay, that's the same idea of momentum in a trend. A trend will be progressing forward, and it may still continue to rise, but it may be losing momentum. And then eventually it's going to hit a tipping point and it's going to slide over. That's what the oscillator's attempting to measure, is what's that momentum looking like. Now here, this is not theoretical. This is practical. This is hands-on. This is what oscillators look like. These are the three we're going to be discussing tonight. The stochastics, the RSI, and the MACD. And you can see, if you look at the chart right here, you can see that this price action of the stock is a little bit choppy in through here. And each of the oscillators takes on a different view of it. The top one here, the stochastics, is a little bit of a smoother view, whereas the RSI is a little bit choppier, very rigid, capturing a lot more of the nuances of the day-to-day moves. And then you've got this MACD indicator down here, which is a very, very smooth move. And the reason it's so smooth is because it's built around moving averages. So where you have a stock like this, where it's got some trends mixed with some sideways movements, you're going to have a lot of trends mixed with sideways movements with that MACD indicator. And we're going to be discussing and looking at some of those things here over the next 45 minutes together. All right, so that's kind of a general understanding of the oscillators. There are two types or two qualifications of oscillators that we're going to be looking at. And this goes for all oscillators. Those of you who've been through the legacy program, you notice a little bit different approach in the way that I'm teaching this tonight. Typically, I used to go straight through the three oscillators, but what I decided to do is I wanted you guys to have a broader understanding of what oscillators are. And then, if you get into this and you say, hey, I found this other oscillator over here. I found the CCI, for example, and I really like it. Well, if you like that oscillator, I want you to still understand how to read it. And so I'm giving you this kind of basic overview on oscillators. And then everything that you're learning here, we can apply it straight over to the over to each of the individual indicators, whichever one you're using. Okay, there are two types in the world of oscillators. There are bound or range-bound oscillators, and then there's going to be unbound. As you can look here on the picture, one of them is stuck within a range, and one of them is built around a zero line. So the bound oscillator is the one that's going to be stuck within a range. This is going to be range-bound. You can see that the bottom here is 0, the top is 100. And you cannot trade higher than 100, and you cannot trade lower than 0. In other words, it is stuck within this range. The readings are going to be limited within those finite boundaries there. Most of the time when you find a range-bound oscillator, it's going to be stuck between 0 and 100. I can't personally think of any that are not stuck between 0 and 100, but Technically, you could theoretically program one to have a different range and still have a range bound in theory. So usually we use those 0 to 100 scale. The infinite one, or the one that's not bound, is going to not have those boundaries on it. Let's take a look here at, in practice, this is a stochastics indicator, range bound. You notice that it never gets above 100. Well, that's because it can't. It's stuck within that range. And so even though the stock might keep trading higher and higher up here, this oscillator, it can't. Once you kind of get to a peak, it has to stop. And that may become frustrating to some people, but it actually gives us the signal, because since we're stuck there, as soon as the stock heads down, it gives us the signal to get out of there, and that's when you get the crossover signal. So that's actually good. It's very important that we have a boundary and a range stuck on some of these oscillators so that they do not run away on us, and that we actually, rather than tracking the stock, we're actually tracking the momentum on them. Now, the unbound oscillator, these are going to be oscillators that have readings that are not limited within a finite boundary. The indicator is going to be built around what we call a zero line, in which 0 represents the equilibrium or the balance. The readings above the line have a positive reading, and the readings below the line have a negative reading. So in other words, if the line's above 0, then it's technically bullish. If the lines are below 0, it's technically bearish. 0 is the zero line. That's the equilibrium. And talking about the positive moves here, notice that the numbers above 0 are positive, 1 up to 4 in here, but technically there's no boundaries to it, so it could keep going as high as it wanted to. And then the numbers that go below the 0 here are negative. We've got negative 1, 2, 3, 4. And again, there's no limit to it. It could technically go as far as it wanted to go, because again, there's no boundaries there. Okay? Now, putting this one into practice here, this is the MACD indicator that we're going to look at in a few minutes. You can see here that some of these have really gone a long, long way. Same trend, same stock. Notice how far the stock went, way up here. And in that particular case, look at the MACD indicator. It just kept going and going. There is no boundaries to it. And then, of course, when it flips over and it goes the opposite direction, there's no boundaries to it. You can see we've already got a -5 reading on here, and I'm sure this was probably a positive 6 or 7 reading up on the top here. So you can actually have quite a bit of range on these indicators where there's no boundaries on them. Both types of indicators have value, both the range bound and those that are not range bound. Both have reasons and both have purposes for us to use them, and that's why we blend them. That's the reason we use a couple of different ones, because we get different readings from each of them. And as you're thinking through the types of oscillators that you want to include in your own analysis, that's what you want to do. You want to kind of synthesize a couple here, get a couple that take on a different approach to the market, take on a different synthesis of the data, and spit out different data to you. So that way you can get the best signals. All right, let's talk about some general principles of oscillators. There's a few general principles that one should consider. Number 1 is the principle of overbought, oversold. Number 2 is the principle of divergence. These are really the two primary principles that oscillators provide us. And then the third principle is the principle of trend analysis within the oscillator itself. Not within the stock, but within the oscillator itself. All right, so let's break each of these down. Overbought, oversold. Well, as I've already alluded to you, momentum's a lot like gravity. I like these gravity balls because they really make a good point here, and it really kind of gets the idea of the oscillator very, very clear. If you guys have ever seen these little doodads, I think they're called gravity balls. You can pull one of these up, and so you pull it up, and then you let it go, and as it swings down, what does it do? It hits the other balls, and then the other balls, this first one that you started with, it stops, and then this guy will come swinging up until the momentum can't go anymore. Gravity takes over, and boom, it comes swinging back, and boom, it hits it, and then the other ball goes in the opposite direction. You guys have all seen these little doodads, right? Have you guys all seen these little doodads before? Kathleen and Ken are calling it Newton's. Well, Kathleen said it's a Newtonian demonstrator. And Ken said it's a Newton's ladder. Is that what it's called? Newton's cradle. Okay, so apparently Sir Isaac had something to do with this. I don't know. I just know they're cool little doodads that you buy in the mall. That's all I know about these things. Anyway, and I thought this was a cool picture of one. That idea there of gravity taking over, swinging down, hitting the ball, everything stops, and then the move goes in the opposite direction, That is the idea of overbought, oversold. Just think of it this way. A stock can only go so far before gravity has to take over again, before momentum has to swing back in the opposite direction. And just because it's swinging in the opposite direction doesn't mean the trend is reversed. It just means that let's say it was a bullish trend, it just means that bullish trend has gone as far as it can go before it has to have a rest or before it has to have some sort of a momentum killer that would swing back in the opposite direction. And then once that swing is done, well, the trend can resume. That's what overbought, oversold is attempting to measure. So as we think about overbought, oversold, remember, momentum's a lot like gravity. Start with the principle that markets move in cycles. Understand that markets do not go straight up and they do not go straight down. In every situation, markets move in cycles. And then as markets become more bullish, the buying pressure starts to send the momentum higher, which must eventually slow at the top. And as that slowing comes in, well, you have a cycle that comes in the opposite direction. And that's where I came up with this statement here that, obviously is not my statement, but every action has an opposite reaction. It's very, very much like the laws of physics. That's one of the principal laws of physics. Every action has an equal and opposite reaction. Well, the stock market is the same way. Whenever something goes up, it must come down at least to a certain degree. Now, it doesn't have to come all the way, but it needs to go at least a certain portion of the way. And that's called a retracement. It's a corrective move. And it's all part of the momentum of the cycles of the trend, okay? So understanding that, let's take a look over here at this Caterpillar trade. And notice I've highlighted in green the core momentum of the move. And, sometimes the trade seems a little jerky. And this is probably the biggest challenge to the trader is they see all the noise, as we would call it, the little whips and bounds or whatever you want to refer to them as, the ups and downs that suddenly come in and out during the day, and it creates noise or it creates a jerky price action. Well, what the attempt of the oscillator is it's to smooth all of that out and give us a clear cycle of that market momentum. So take a look here. Notice how the green line that I've drawn in here really hits the peaks and the valleys. And if you were to sit here and mark them, the oscillator is also hitting those peaks and valleys. And it's just measuring the momentum of those swings in there. And so that's the nature of the oscillator. Now, sometimes you're going to notice, and this is a principle we're going to look at as we move further here tonight, sometimes you'll notice that there's times when the oscillator swings higher with the trend, and then the trend keeps going higher, and the oscillator starts going in the opposite direction. And that's a very important principle. It's a principle called divergence that we're going to be looking at here as we move further. But as you see this move right here, notice what happens. Notice that the stock will swing higher, and it's about the time that the oscillator can't go much further that we have to have a corrective move. It doesn't have to be a big move, but we've got to have a corrective move. And notice in that corrective move, proportionally, this stock went from 70 to over 90, and the oscillator went from down here around 20 all the way up here to 90 or so. But in this retracement here, we only went from about 95 or 93, maybe down to about 85. So proportion is a much smaller move, but that was all it needed for the momentum to swing back down to the bottom so that we could say, okay, we've swung that way. Now we can get another bullish swing in here. And in this particular case, we actually had a little sideways swing right in through there, but it really doesn't matter. The idea is that the momentum indicator is measuring the ups and the down swings in the market. And if you can get a good idea of how the momentum is swinging, you can get a better idea of how to time some of these entries and especially some of the exits. Okay? Now, as we think about overbought, oversold, understand this. When the market reaches a swing high, the oscillator will theoretically register an overbought reading. As we reach a swing high, we will theoretically be reaching an overbought reading. When the market reaches a swing low, the oscillator will theoretically be registering an oversold reading. And of course, as we've already addressed tonight, markets tend to cycle. And they tend to cycle between these levels or these momentum swings that we would call swing highs and swing lows. Let's take another look over here at this picture, and I've drawn this one just slightly different. Same stock, same image, but each of these are swing high and swing low points on the stock. And within each of these swing points, we get a swing high and a swing low within the oscillator. The area that I've shaded red, this is your overbought area. The area that I've shaded green, this is your oversold area. And so, of course, once we've got down to oversold, the natural momentum is for the cycle to swing back in a bullish direction. When we've reached overbought, the natural progression is for the market to cycle back into a bearish progression. So you can see how these swing highs and these swing lows and the momentum indicator are lining up in there. Okay? Now, let's talk about the idea and the concept of divergence. This is the second key principle that you're going to find across pretty much all oscillators are going to have some sort of divergence that they reveal. Sometimes what happens is the peaks and the valleys of the oscillator do not match the movement in the stock. And you can see over here on the right side of the screen, you can see an example of this. Notice that the valleys in this particular trade kept going lower, but the valleys of the oscillator were going higher. You see that? That is called a divergence. This is a signal that the momentum is changing. It's a very, very important signal. I cannot emphasize it enough. In fact, this is one of those signals that when you see it, you really got to pay attention to it because it's a big, major warning sign about what might happen with this trade. If the peak or the valley of the stock does not match the peak or the valley of the oscillators, we have a divergence. And divergence very, very often precedes a reversal. Let's take a look over here at an image. If I can move forward, there we go. Same stock. Just kind of use this one for a lot of the examples tonight because it's got so many great examples here. No reason. We could use lots of them. But they're all going to look pretty much the same. Notice over here between August and October as the trade's making lower lows. Okay, so over a 2-month period, we make a lot of lower lows. But look at the oscillator as we are making a sequence of higher lows. So the matching lows that match up with these peaks, it would look like we're in a downtrend on the stock, and it would look like we're in an uptrend on the oscillator. Now let's come over here to this this next one, the one that happened between January and March. And in this case, we've got higher highs and lower highs on the oscillator. You see that? Higher highs in the stock, lower highs in the oscillator. This means that the oscillator is diverging. It's going in the opposite direction from the stock. Now, if you come on over here to May of this year moving into July, notice this sequence of the bottoms making lower lows and the bottoms of the oscillator making higher lows. Again, this is another divergence. And so you can see the idea. Most of the time, if the stock's making a higher high, the oscillator's making a higher high. And most of the time, if the stock's making a lower high, the oscillator's making a lower high. But whenever they do the opposite, we've got a divergence, and that can be a very, very important signal as we're analyzing and paying attention to what the momentum is telling us with our trades. Bearish divergence, also referred to as negative divergence, appears when the peaks of the stock do not match the peaks of the oscillator. When the peaks of the stock do not match the peaks of the oscillator. Bullish divergence or positive divergence occurs when the valleys of the stock do not match the valleys of the oscillators. When the valleys of the stock do not match the valleys of the oscillators. When these signals occur, be extremely aware of a potential impending reversal, because I'm telling you what, as soon as you don't heat it, this sucker is going to reverse on you and it's going to burn you really, really bad. These are some of those warning signals that nobody ever wants to admit are happening. And you always think, well, this thing could keep going in the other direction, and it could. But this is the time period that you really can lose a lot of money. So pay attention to these divergences. It's a very, very important signal. Let's take a look over here. Just kind of fleshing out that same Caterpillar trade here. Notice this is a positive divergence over here between August and October. We've got lower valleys on the stock and higher valleys on the oscillator. And notice that they're corresponding. They're corresponding valleys. So in other words, it's the ones that go together here. It's not just randomness. It's these specific valleys go together. That creates the divergence. Up here in the top, we've got higher peaks versus the lower peaks here. So we've got the lower peaks and we got the higher peaks. Again, they go together. And then finally, the one on the right here, we've got the lower valleys, again, with the higher valleys. Now, this is really important that you understand this. A lot of people try to draw divergence and they draw it wrong. And the most common one is that they draw it on the wrong side. This is a little bit against what I've taught you, because I've taught you that in a downtrend, the resistance line is king. And that's really true if you're dealing with trend lines, but not with divergence. If you're dealing with a trend line, you might draw a line like this and say, well, it doesn't look like it's diverging that much, or maybe it's kind of diverging. That's the wrong spot to draw it. You draw it off of the valleys for a bullish divergence and off of the peaks for a bearish divergence. And if you'll make sure you do that, you'll hit these a whole lot more accurately, and I think you'll be in a lot better shape. All right. So that's the way that the divergence works here. Divergence. Can we move? There we go. Divergence is not a signal that you want to switch directions. It is a signal that the momentum is changing. That is the signal that you're getting here. It's not a specific signal that you need to reverse. It's just a signal that momentum is changing. Beware. You need to be using much tighter stops and keep your eyes open. There could be a reversal, and it could be a major reversal very, very quickly. It can occur just 1 or 2 days before the reversal, or it could occur several weeks. And then the larger the time frame of the divergence, the more important that signal and the larger scale the reversal is that is likely to follow. Take a look over here at this picture. And notice that this first divergence, that's a bullish divergence, it's about 8 weeks in time frame from the beginning of August to the beginning of October. So it took about 8 weeks to fully shape up. You know, these are not things that occur overnight. It takes a little bit of time. But by the time this one had started to shape up, the trend was pretty much done, and we actually got the reversal in there. Notice what's happening with the momentum. The stock is obviously selling off. The price is looking lower, but the momentum is saying, we're rolling over. Comes back to that idea of gravity. When I say you have a ball, you throw it up in the air, and it's still going higher, but the momentum is slowing, and eventually it hits a tipping point, and it comes tumbling back down. Or in the case of a ball, it probably would go more like this, you know, woo, monk. That's more like what a ball would do, right? Well, that's the same thing that's happening with the stock here. In the case of this bullish or this bearish divergence over here, during the bullish trend, we're trading higher, and the momentum is moving up very, very quickly. But then as it starts to slow up here, the momentum oscillator is starting to slow, and it's already heading downhill, giving us that bearish divergence. So you can see that idea there. This one took about 6 weeks to shape up here. Between the peak here and between the two peaks is what I'm trying to say. This last one over here actually was much longer, and it's much stronger in terms of its move. Generally speaking, the longer the divergence, the stronger the reaction once it finally breaks out here. You can see what happened. We had a very rapid sell-off initially, and then we just kind of started getting into a little bearish channel here at the end of the move. Well, during that bearish channel, we've got bullish divergence that's happening. We ended up with 3 touches there on that valley before the reversal came in, and there's actually a good chance that this trend may continue because it's only been a small reaction, relatively speaking. But you can see what happened. We moved up from about $75, $78 up to the 90s, and we're just getting a little correction. But look at how big, it's a small little correction, but look at how big proportionally the reaction is in the oscillator, showing that most likely this is actually a continuation move as we're getting a little bit of a breath and getting a little bit of a rest in that momentum. All right, so does that make sense to you guys? How many of you feel like you understand divergence a little bit better now? Make sense? Okay. Let's talk about the idea of trend analysis as it relates to oscillators. This is a new concept. I left it out of the old program. I didn't think it was practical, but I've decided that it's worth throwing in here. So you guys can tell me at the end of class if you think it's practical and if you think we should continue teaching it. If not, I'll take it out the next time I